So good morning and welcome again to another entry in the JMM virtual event series. My name is Jane Morgan and it's my pleasure today to host you for this deep dive on the nuclear energy sector. We are witnessing a global shift in the energy landscape, with nuclear energy consistently being the topic of conversation among many nations around the world. Even just over the weekend, with one of President Trump's latest executive orders speeding up the deployment of nuclear reactors in the US, several jurisdictions are certainly making their positions very clear. Not only nations, but also organizations. New reactors are being commissioned around the globe, with tech giants like Google and Microsoft exploring the use of nuclear energy for powering their infrastructure. So even developments in other sectors like technology, with of course the rise of AI and data centers, means that this shift is here to stay. So in Australia, while nuclear power generation is still prohibited for the foreseeable future, there is still a growing discussion surrounding the feasibility as well as the benefits that all sides of politics are cognizant of, whether it's energy and economic security or environmental considerations. So today's event is structured to give you a comprehensive overview of some of these issues, as well as outline some of the opportunities that exist for investors off the back of these global developments. We'll have our first keynote speaker and Q&A up first, followed by a selection of leaders from Australian companies in the nuclear space. If you've got any questions for our presenters today, please use the Q&A function, which can be found at the bottom of your screen. But we'll kick off. So our keynote speaker today is Guy Keller, the portfolio manager for the Tribeca Nuclear Energy Opportunities Strategy. Guy, I'm going to hand over to you for your keynote presentation.
Thanks, Jane, and hello everyone. It's great to be back again. So I was just commenting to Jane the other day that her timing was absolutely impeccable in when we were looking for a date to schedule this, because we've been sort of bumbling along in the uranium sector and the nuclear landscape for a few months, and then just last week we saw some truly seismic policy shifts coming out of the US. That has put nuclear back in front and center in US politics and US mainstream media, and then as a result of that, obviously uranium being the only raw material that can power those nuclear power plants. So well done on picking this week to host this. But so it comes down to, as Jane said, I run Tribeca's Nuclear Energy Opportunities Fund. I work for Tribeca's Global Natural Resources business. I've been doing this for just over 8 years now in this fund, and have had some good times and bad times, some false starts, a little bit of a heartbeat off the bottom after a decade of neglect in the uranium sector. And to be perfectly frank, we've had a period of 12 to 15 months of some underperformance in the uranium sector, despite an emerging theme of data center demand for electricity, which I'm sure you're all hearing and reading about, that then was thrown in with a little bit of geopolitical uncertainty as President Trump threw tariff threats and headlines around the world and creating a more broader macro. So I didn't actually think we would ever have a situation where there was going to be a chance to re-enter some of these uranium stocks at such heavily discounted levels, and when we've obviously seen a bounce off those lows in the last few weeks. But as I'm probably going to explain to you, or hopefully explain to you clearly in the next 10 or 15 minutes, we're nowhere near solving a mathematical equation despite stock moves off the bottom and despite a slightly higher uptick in the spot price of uranium. And that mathematical equation is just simply supply and demand. For those who've heard me speak before, I've come from a commodity trading background, where EV to EBITDA and things like that don't matter. It's how much is being dug out versus how much is required, and if there's inventory, where is it, and what's the future demand. And what we've seen in uranium is obviously Fukushima in 2011. There was some very public political decisions around shutting down some nuclear capacity, Japan being the most obvious and most immediate, and then Europe being led by Germany, what people fail to recognise is that whilst the Germans jumped up and down in 2011 about moving out of nuclear, it basically took them most of the decade to shut those reactors down. So what we've actually seen, and this is where it comes to that mathematics, is since Fukushima, we've still had 420 odd reactors burning uranium in nuclear fuel since 2011 to today in 2025. What actually happened in the uranium sector was, as a result of Fukushima, capital basically dried up overnight. It started in explorers, so anybody exploring for uranium had the rug pulled from underneath them, and they've spent 10 to 15 years, it's hand to mouth, just trying to get through to find capital. And then what we then saw was project developers had capital pulled, so they were unable to progress with their projects, and then producers, obviously, with low prices that came from, coincidentally, the Kazakhs ramping up their production in response to what was back then a good market, flooding the market with uranium. So we've had a decade plus of 420 reactors continuing to consume uranium, and we've had a decade plus of almost zero capital going into finding new uranium. So, fast forward now, it's still a mathematical equation. Last year we produced about 150 odd million pounds of uranium globally. Yet the industry consumes about 190 million pounds. So, and that's been 150 has been an increase over the last few years after supply was curtailed and shut down. So, we've had, again, that decade of secondary supply and inventory being drawn down, and that's a very important thing to talk about, because it would kind of make sense that in periods of low prices you take from the market and preserve your inventory, but the uranium sector's actually nuclear sector's done the opposite, spent a decade consuming inventory instead of building it. So fast forward now, we have a period where we've had some supply response, and that's been great to see, but almost to a T, there's literally been zero greenfield. So we sat here at an $80 term price, and that's important because the spot price is irrelevant to investors like myself who are looking for price certainty in producers. Where 98% of the business that happens is basis of term contract, or 95% if you want to be, where producers or developers are talking directly to a utility and putting long-term contracts in to give them the certainty. So we've sat at $80 for more than a year now. In fact, almost 15 months or so. And the spot price, while it's been noisy, up to $106, down to 64, and now sitting at 72. The real price in which supply is being set, the supply, offtake is being set, has basically not moved, and it's stayed sticky at the highs. Yet we're seeing no greenfield response in uranium projects. And as I said, it's been great that there's been some brownfield care and maintenance response. Almost all of them have had some issues in restarting. Some of them are through that, and you'll hear from Duncan after me at Boss Energy, who is through that restart process and is in the process of continuing to ramp up. But I look at that demand equation now, and I say, when I first looked at this thesis in 16, 17, 18, I had the Western demand kind of petering off, China and India kicking up, and so net I had sort of flat demand. And I've modelled a lot of different commodities over my career. I can tell you that uranium demand is probably the easiest demand curve to model, because it's inelastic and it's long term. So a utility, if they're going to shut a reactor down, doesn't do it tomorrow. They don't do it in response to global macro or global economic cycles. A decision to shut a reactor down is a long-term decision. It takes a number of years. The fuel cycle in the way it's structured means that uranium in a reactor today was purchased probably 3 or 4 years ago, because it goes through conversion, enrichment, fuel fabrication, which used to take about 18 months, but with Russian geopolitical issues now takes 2 to 2.5, maybe sometimes 3 years now. So utilities are long-term in their thought process, and they take a while to build as well. So the Chinese and Koreans are showing us that the fallacy that they're too expensive and take too long is actually incorrect. Yes, it's been the case in the West. Building gigawatt scale reactors has been tough, but when you're only building one every decade, that's not that easy to do. And so the demand now we're finding is that China's even ramped up even more. So China have got now 35 reactors under construction. So again, building nuclear takes too long, it costs too much. There's 70 odd reactors currently being built around the world. More than half of that or around half of that is China, but there's another 10 or so countries that are also building nuclear. So we're kind of proving that to be incorrect, that it's not too expensive, it doesn't take too long, or if it is, the trade-off economically is worth the energy security you get from 60 to 80 years of baseload electricity, and if you're in the US, running 90% of the time. So 335 days of the year, nuclear is kicking out 24/7 electricity. The global average is 80% capacity. And a lot of that is because some grids force nuclear to try to pull out of the grid to make way for wind and solar. But we've got a very solid demand curve. So I've got now deficits, even with the most positive thinking in response to greenfield supply. I've got deficits out to 2033. And I caveat that with saying those deficits, primary mine supply deficits, do not include a significant small modular or advanced modular reactor demand. So I don't have any of that priced into my models, and yet I still have deficits. I'm a bit more realistic than the uranium industry, who can often have timelines that look great in a corporate presentation, but when it comes into practice, sometimes don't. So I push out a lot of supply a few more years. But even if I brought that back to what I was seeing on a PDF from some of these developers or their PowerPoints, I'd still have a primary mine supply deficit. And that's because you're seeing a reset in the West. You're seeing an acceleration in China. So let's put this into perspective. 65 reactors will be connected to the grid, 65 additional reactors. So that's on top of the 450 reactors we have in the world. 65 additional reactors will be connected to the grid by 2030. That on a conservative uranium demand is anything from 33 to 38 million pounds of uranium per year for 60 years. Between now and 2030, we'll also have a number of those Japanese reactors turning back on. We'll have 3 Mile Island restarting in the US. We'll have Palisades restarting in the US. Again, we never thought we'd see a time where the US was restarting idle reactors that were shut down. Just incidentally, 3 Mile Island, you might be sitting there saying, why do I know that name? 3 Mile Island was the site of the only nuclear accident in the United States in the 70s, where one of their reactor cores, one of their reactors had an issue and had a partial meltdown. The other reactor continued right next door, same site, same car park, same cafeteria. That reactor continued to produce electricity until not that long ago, where it shut down because of economic reasons. So just and same with Chernobyl as well. As a matter of fact, once that dome was built over the reactor that had the issue, the other reactors continued to produce electricity as well. So anyway, just a little side there. So as I said, we're seeing all of these restarts in the US. We're seeing China, and China, just by the way, will be announcing another 10 reactors every single year. So they've announced 10 more that they've started construction or will start construction in 2025. 2026 to 2035, they're telling us they will start another 10 reactors every single year for the next decade. So to put that into simple maths, if it's 10 gigawatts or 10 1 gigawatt reactors or thereabouts. That's about 5 million pounds of uranium per year for every single one of those, on top of the 35 million pounds that's going to be from the ones being constructed right now. So we've got massive demand coming. We look back at the Trump administration policy announcements recently, and again, advanced and small modular reactors aside, they've announced in the US that they want 10 gigawatt scale reactors under construction by 2030. So even if you put a worst case scenario on that and say that they won't start until 2030, or maybe 10 don't actually start because something happens and Trump gets voted out, the next government comes in and changes things. Even if there's 1 or 2 or 3 or 4 or 5, that's demand that we don't have in our models right now, and I'm certain utilities aren't thinking about either. So we've got a big problem coming for utilities, where most of them are pretty well covered for until 2026 or 2026, 2027, because of the nature of the fuel cycle. But tomorrow for a utility is 2028. So again, the misconception, the market looking at the spot price saying the spot price is doing nothing. Utility doesn't need material for the next 3 or 6 months. They're not thinking about that. Every RFP that we know is coming, request for price, every bilateral conversation that we hear is happening between producers of uranium and utilities who are the consumers, they're not saying, Duncan, how much can you give me this year? They're saying, how much can you give me from 2028 to 2035? And in some cases, further out to 2036, 2037. And that's that disconnect between the investable market, the equity market, looking at this silly spot price, and what's actually happening. There's a whole bunch of utilities all converging at the World Nuclear Fuel Market Conference next week, and I'll be attending that and hopefully meeting a number of these fuel buyers. And it's going to be really interesting timing, because they've been distracted. And when you look at these guys, like Constellation as a $80 billion market cap company in the US, runs 21 gigawatts of nuclear power plants in the United States, and their fuel buying team is 4 people, 5 people. And those people are going from uranium all the way through to fabricated fuel rods, with transport, with storage, with dealing with spent fuel, with refueling processes. That team they've got a massive job. They've been distracted by conversion and enrichment, with Russian bans on US imports of Russian nuclear fuel into the United States being banned, with Europe considering Russian sanctions on nuclear fuel. A bill in the Senate at the moment, the US, it's got 81 co-sponsors threatening to impose 500% tariffs on any country seen to be buying Russian oil, gas, coal, or nuclear fuel, if Russia does not come to the negotiating table on Ukraine, and also if Russia then pursues further aggression after that point. So there's a huge amount of uncertainty that's distracted these fuel buyers. But the rubber is starting to hit the road, because they're starting to get to the point where the converters, which is where the uranium goes from mine mouth, it goes to one of 3 conversion sites around the world, Western, otherwise it can Russia and China as well. And that's where it starts the fuel process. The converters are now saying to these utilities, we actually need you to deliver the uranium to us. In the past, we've let it slide. We've lent you material. You've had some in France and you're processing in Canada. Now, because of geopolitical and tariffs and all sorts of things, they're saying to these utilities, we want the uranium. So the utilities are now looking back upstream and saying, wow, we probably need to focus on that again. So that's where we are. We haven't even talked about tech companies and that global push. But for a long time, the base load in the West has been base load electricity 24/7. It's been the industrial base has wanted that. The industrial base in the West is offshored. It's gone to other countries. So that's been declining. And what you have left, we use the US, is aluminium smelters in upstate New York doing deals that discounted electricity to keep themselves with half an ability to make some money because they employ 3,000 or 4,000 people in an aluminium smelter. We've now seen since early last year the very public emergence of data centers, of hyperscalers, of tech companies who are demanding baseload electricity. They need 24/7 electricity to cool, to power these data centers, these hyperscalers. It's uninterruptible. There is no ability for them to turn around and say, it's 9 o'clock and the wind and solar and battery storage is gone. Yep, fine. But they're also proving an ability to pay over the wholesale price. We've seen that with Microsoft, with Constellation, with 3 Mile Island restart. The wholesale electricity price, $40 a megawatt hour. Microsoft paying 2 to 2.5 times that to encourage Constellation to restart an idle nuclear power plant. And so that's where we're also seeing this drive for small and advanced modular reactors. None of the technology in small and advanced modular technology is new. It's old science. It's old physics. We've known about it. We've been running molten salt and temperature gas-cooled reactors in test labs around the world since the 50s and 60s. It's not new science. What is new, it's new for regulators, and we've seen now the Trump administration trying to force changes at the NRC. The NRC, coincidentally, since they took over from the Atomic Regulatory Agency in the United States, the NRC has only overseen 2 reactors in the United States, and that was Vertical 3 and 4, which only just finished. They've been very bureaucratic, and the Trump administration is trying to change that. So I think, as I said, I can see Jane looking at me. I think that's coming. That's going to be a big demand driver. We've got the customer who's prepared to pay for the electricity. We've got companies, OPG, Ontario Power Generation, are moving ahead with the BWR X300 from GE Hitachi. They're building 4 of those. Yes, the first one's expensive. Second, third, and fourth ones are less expensive. The blended cost of kilowatt capacity is high for the first 4. But every single study that's been out there has said, first of a kind to nth of a kind, there is savings. And you can't tell me that the human population who now have got tech companies sending rockets up to space, solving problems that NASA are unable to solve, for decades, that battery electric vehicles with battery technology and car technology, and even solar, the cost savings that we've been able to find there in modularization, in mass production, in doing the same thing over and over again. And the world sits there and says, with small modular reactors and advanced modular, oh no, we can't do that. That's rubbish. So we will, and it's coming. I'll stop there.
Guy, love the insights as always. I'm going to jump into a bit of a Q&A now. Just, obviously our users, our listeners here on the call are obviously interested in hearing a little bit more on your thoughts. So Australia obviously still currently prohibits nuclear power generation. Where do you see this heading for Australia when it comes to power generation specifically? Being realistic, or is it a primary focus here going to remain on providing for other jurisdictions that are leveraging nuclear more?
Look, Australia's in a rock and a hard place, and we're going to probably have to have some very hard lessons with respect to our electricity grid, especially on the East Coast. I think we're going to look forward and see that coal is going to be around much longer than people were hoping. I kind of actually think as well, there's a slight blessing in disguise if it is another 3 or 6 years, assuming the coalition want to continue with the nuclear policy. If it is another 3 or 6 years until they get in, there's almost a chance that we get nuclear power connected to the grid here faster or around the same time as if we'd tried to start now, because we were trying to go down the route of gigawatt scale builds. In 3 or 6 years' time, there's going to be small modular, and when I say small modular, 300 megawatt units, in the early 2030s, that are going to be starting to really hit their skids and be mass produced. So assuming Australia has the political clout in 3 or 6 years time to to get to the top of the queue, because every country is going to be lining up for this once it's proven technology, then we may actually find that we're connecting 300 megawatt units in old coal sites by mid-2030s anyway. But the nuclear story per se and the investment opportunity is not Australia. It's global, and it doesn't matter what Australia ends up doing down here, apart from changing sentiment for investors. There is a nuclear investment a uranium investment opportunity here in Australia, obviously, and potentially with nuclear off the table with the Albanese government, potentially there might be some economic arguments to sway some of these states, being Western Australia and Queensland, to change their policy views on uranium itself.
Absolutely. Look, and I think recent political developments have brought nuclear energy back into the spotlight. And it was obviously a topic for the latest election. So what was your latest take on it? And how do you see the current political landscape influencing the future of nuclear energy in Australia?
Yeah, so I guess I kind of answered just that question early, but a little bit there. I don't see the current government doing anything to advance nuclear power or even look to repealing this ban on nuclear power in this term. As I said, I think we probably have to have a bit more of a crisis. And when you talk to industrial users of electricity, they are pretty much, and including data centers, they're pretty much the only things stopping retail, homes, mums and dads, especially in Victoria. They're the only things stopping them from being in brownout and blackout in overcast, humid summer days in the summer, because they're being told in load shed. So data centers are turning on diesel generators so that mums and dads don't go into brownout. I think we probably have to see a little bit of that, unfortunately, to really start swaying opinion. But then again, it's not good. Nuclear is not a solve for tomorrow's electricity problems in this country. It's a longer term solve, and it probably does need a change of government at the federal level.
Guy, bear with me. There's quite a few questions coming through, but okay. So what are your thoughts on the impact of traders or groups like the Sprott Uranium Trust buying pounds in recent years? So do we see their influence continuing on spot prices and near-term pricing in market?
Yeah, look, I mean, we've obviously seen a group of hedge fund traders, especially East Coast US guys, that have worked out how to control the uranium market. I mean, the global market cap of the uranium sector is tiny. I mean, you can still fit it inside the market cap of companies like Fortescue and things. There has been a pretty heavy short interest across the ASX and also TSX and US uranium stocks, and they've been able to control the spot, because the reality is Sprott Physical Uranium Trust is the only financial buyer that can constantly be in the spot market. Investors make the wrong assumption about the spot market. They kind of view it as any other commodity market. I can tell you, spending 25 odd years trading physical commodities, where my least favorite commodities used to be tin and crude palm oil. When I met the uranium physical market, I realized very, very quickly that was the top of the pile of my least favorites by a country mile, because it's not a big market. I mean, there's a handful of traders moving stuff around. There's not buyers in there all the time. There's not sellers in there all the time. And spot was playing a role to soak up surplus pounds and stop those games being played. But now you've got these hedge funds who are stopping it trade to a premium to its NAV, so it can't raise money to buy pounds, and that's allowing them to stay short these uranium stocks. So, that will reset, and as we've seen in the past, when the spot does get active, it moves that spot price very quickly. And again, all these people saying this is a genuine market, the moment that spot raised that money the other day to reduce the overhang of them potentially selling pounds to fund their operating costs, the moment that came out, the spot price popped $2.50. Not a functional market.
Absolutely. Look, I think there's just a couple here actually on utility offtakes. So in your opinion, when will utilities finally sign offtake contracts with sort of the junior miners which are not in production yet?
Yeah, look, so it's a real chicken and egg issue, and what we've seen with two of these restart projects, and again, they're already built, the infrastructure's already in place. They've got themselves into trouble because they've signed offtake agreements and then had delays. And so they've had to, in one case, borrow pounds from Duncan, and in the other case, go into the market to buy some pounds to fulfill those delivery obligations. So, from an investor perspective, from my perspective, I'm saying to wannabe producers, especially greenfield projects, don't sign these yet. There's no reason to sign them yet, because at the end of the day, all that utility's giving you is a piece of paper saying, hey, when you're in production, I'll buy you pounds at this, floor and ceiling or this escalation or whatever it is. But if you don't get into production, I'm going to come after you for those pounds anyway. I'm not going to give you any money to go and build your mine. And if the prices materially increase from here, I'm going to hold you to that price that I've locked you in at. So they're not worth the paper they're written on until such time as you're potentially getting debt finance, and that's a requirement of the debt financier to say you need a certain, we need certainty of cash flow, because you're just going to get yourself into trouble if you're signing them too early. Because if the price does what we think it needs to do, which is it has to go higher, because at $80, we're not seeing any near-term greenfields rushing to get into production. So it has to go higher, and you are 2 or 3 or 4 years out and you're signing contracts here somewhere between 80 and 72 and $80, and then you've just got this noose around your neck. An investor like me doesn't want to be there.
Yeah, interesting times, isn't it? I mean, I think also we'll move on to public opinion. So public opinion on nuclear energy in Australia in particular is always shifting. How significant is public perception, probably the public most broadly, in sort of shaping nuclear energy policy? And what kind of strategies do you think can be employed to inform and engage the public effectively?
Yeah, I mean, so a lot of polling, and not just in Australia, but in the whole Western world, and including countries that have got nuclear, is that the younger generation, the 15 to 35s, are accepting of nuclear power because of the green credentials. And then in Europe, you've seen these, pretty hard left green parties coming out in public support of nuclear power because of the green credentials. So, I mean, I will caveat to say that in some of those cases in Europe, it's where capacity is already built. So once it's already on, it's much easier to turn around and say, let's keep it on. But you are seeing that shift. You're seeing sustainability investors, global sustainability investors, who are supportive of nuclear power. Germany's now basically come out and said, we're going to stop fighting France over nuclear. We're going to allow France to push forward in EU legal negotiations around green bonds and what have you. So, there's a lot of investor and political support for nuclear power. And as I said, there's age brackets where nuclear is accepted. I think in places like Australia, where there was some, in the last campaign with the coalition there, the campaign around the local areas where they were proposing those nuclear power plants. And remember, these are sites where there's been generations and decades of power production because there was coal-fired power generation. And when that conversation shifted to jobs and prosperity, and when you think about it, Vertical 3 and 4 had almost 10,000 people completing construction of those reactors. And that's important for two reasons. That's 10,000 people who got comfortable working on a nuclear site. That's 10,000 people in Georgia who got pretty good paying jobs. And that's 10,000 people who can potentially work on future power plant production in the US when they go down that path. When you look at that and you pitch that to these local communities, and they're not cities, obviously, in Australia, and say, there's going to be thousands of jobs, which means that, your hotels, your motels, your B&Bs, your cafes, your pubs, they're all going to be full. And then there's going to be hundreds of high-paying jobs for 60 years, plus whatever else comes with cogeneration, whether it's hydrogen or desalination or district heat or low industrial heat or data centers. It's rejuvenating these things. So when it's pushed down, and that was the Department of Energy in the US, when it came to communities about jobs and future opportunities, they were supportive of it. And, I would rather live, not in my backyard, I'd rather live next door to a nuclear power plant than a coal-fired power plant 100 days of the week, no problems.
Agreed. Look, a couple of questions. I'm going to actually combine these two into one. But so small modular reactors are often discussed as a potential solution for Australia's energy needs. So first one, what are the advantages and challenges associated with implementing these SMR, into the Australian context? And do you see this as a possibility in the near future?
Yeah, so as I said, the physics and the science is not new. And in fact, Australia could actually position itself to be in a position where we could manufacture a whole bunch of these components to roll them out through parts of Southeast Asia and Asia Pac. So it is coming. The challenge, I think, for Australia is going to be to do it properly, because we're not necessarily a huge market. I mean, we do have 21 gigs of coal capacity in the NEM that in theory can be replaced, or a portion of that. We would need to settle on probably one company, one design, and champion that vendor to build everything in Australia, because that's where you're going to get the economies of scale of being able to do that. And as I said, there is an opportunity for 300 megawatt units to replace coal. The beauty about that is we're a very long grid all the way down. So, you don't necessarily want big 3 or 4 or 5 gigawatt air sections. You can space that and run your grid much more efficiently. And also that helps with stability of all your wind and solar coming in and shaking up that platform. But also with the micro reactors, we have that opportunity with remote mine sites, remote communities, and a whole bunch of things. So if we were to settle on one small modular 300 megawatt type design, and then some sort of micro reactor, 5 to 50 megawatt units, I think that's where Australia needs to land. Because if we try to get a whole bunch of technologies here, we're never going to get the economies of scale to be able to do that.
There's a lot coming through, guys, so bear with me. Look, from an investment perspective, how attractive is the nuclear space when it comes to Australian investments compared to other nations? And what factors are most critical in making investment decisions?
Yeah, look, so when you look at the ASX, there's basically no nuclear opportunities on the ASX. You do have a fuel cycle opportunity there, obviously, with Silex, with laser enrichment, and you've got a little bit of an opportunity there with what global uranium enrichment. I think Andrew's speaking later has got with that chemical enrichment technology. So on the ASX, most of the opportunity is uranium, and that spends from producers being Paladin and Boss, all the way through to explorers, some of whom you're going to hear from today as well. There's Australian jurisdictions, there's US, there's Canada, and there's Africa. So you actually do get a good spread of jurisdiction through that uranium cycle. And there's a couple of greenfield ready to go, and then a few restart projects that are still trying to restart at the moment. So there actually is. The problem comes down to, for the institutional investor, is market cap. The biggest two are a couple of $1 billion each, and then it really falls off that capital spectrum then. So, that's where it becomes a bit problematic for institutional investors, because they say there's nothing really big enough for us to sink our teeth into here. Right. But it is the same problem in Canada and US as well, although Cameco being a 20-odd billion company, it does open up, make it much more investable in North America. So about 70% of my well, 60% of my uranium exposure is offshore, and about 40% is here, primarily in near-term pounds at the moment.
Thank you, Guy. We always run over every time we do this event, but I'm going to keep going because I know that there's a lot of questions coming through. So, and a lot coming through when it comes to the cost of nuclear energy. So whether it's developing or producing the raw materials, or even funding that goes into nuclear power generation. So can you give us a quick overview, of the cost of nuclear compared to other traditional energy sources, and then specifically compared to some of the other top contenders of the energy transitions like renewables?
Yeah, so this is always, always the contentious issue, and we're kind of talking about this offline earlier. The nuclear power generation sector is really, really bad at communicating how good an energy source it is. It's had decades of being flogged by greenies. It's been flogged by oil and gas and coal, who are very well funded, fantastic, slick lobbyists, and nuclear's just sort of bumbled through and just quietly done its job, but not really promoted itself. So, when you look at the Ontario power generation small modular reactor experiment, for example, their first unit they're saying is going to cost them, they're 300 megawatt units. So their first unit they're saying is going to cost them around 6 billion Canadian dollars. And the next 3 units will cost them about $4.4 billion. So from just that first unit, the first reactor they've ever built of that technology, to the fourth, there's a 30-odd% cost saving. But when you look at that as the total cost per kilowatt capacity, it's still high. But again, if you then argue, so there's a consensus that first of a kind to nth of a kind costs will come down around 40%. My view is that's extraordinarily conservative. And I hark back to what I was saying earlier, battery technology, even solar panels, wind technology, battery electric vehicles, first of a kind to now nth of a kind, we've seen much more than 40% cost efficiencies. But even if you argue we managed to save 40% from first to nth, it becomes extraordinarily competitive. The OPG example, to get the electricity generation of that 1,200 megawatts from those 4 units, this is Ontario, so it's not Australia, it's not as sunny, but it's windy. They would need, I think it was 8.9 gigawatts of wind and solar to get the same electricity generation, so the same number of electrons that were produced. So it's almost 9 times the capacity. And then what they don't say is how much battery, how much hydro, how much transmission they need to build to back those up when they're not producing. So as I say to you, I would rather something that looks expensive up front, that's going to last me 60 years, that's going to give me electricity from not only at midday but also at midnight, and do that 300 days of the year. And I mean, for example, anyone here in Sydney, we've had 2 weeks of rain and limited wind, and when it has been, it's been very gusty, but it's been rainy and overcast. Anyone who's got rooftop solar should have an app. Go back and look at how much solar you generated. I guarantee you, mine was about a third of what I generate, or normally should generate at this time of the year. So even if I have a battery, which I don't, not producing enough electricity to even charge my battery. And so I would therefore have to build 3 times the capacity on my roof just to get an overcast day. But so, as I said, everyone, like the wind and solar renewables, and as I'm not dissing them, there's a spot for them, there's a place for them, they do good things, but it's not baseload. And so, that cost equation every single time. Also, people say to me the cost of nuclear fuel. With the all-in cost of a nuclear power plant, the fuel component is about 30% maybe. So even with the fuel cycle, so conversion, enrichment, SWU prices all being at more than decade highs, the fuel is still not a big component. Uranium, I think, is about 9%. So even if it doubles, I think it goes to about 12% of the total cost, because the cost is building the things. Whereas coal and gas are up 85 to 90% is the coal and gas prices, their operating costs.
Guy, as we do this every single time, we always run over by a good 20 minutes. But if we have missed any of the questions for Guy today, I would encourage you to reach out via info@jane@morganmanagement.com.au, or you probably have Guy's details as well. But Guy, thanks so much for your insights. We look forward to hosting you again next time.
Thanks, Jane. It's been fantastic, and as I said, I think this is truly the beginning of a contracting cycle and a market move in the uranium sector. We have had a few false starts, but the stars have realigned, and I think with all this policy support, we're going to see a really interesting time and hopefully profitable for everybody that's invested in it.
Absolutely. Thank you again, Guy, and let's jump into today's presentations. So up first, we have Duncan Craib, from the Managing Director and CEO of Boss Energy, with the ticker code BOE. I don't imagine that Boss needs much of an introduction. However, the company's flagship asset is its 100% owned Honeymoon Uranium project in South Australia. To tell you more, I'm going to hand you over to Duncan.
Jane, thank you. Thanks very much for hosting today. And, it's a hard act to follow with Guy. He is arguably one of the most experienced and knowledgeable fund managers globally. So, yeah, really good comprehensive sort of opening that Guy gave. So just picking up on some of those key points that he made, really for us, we look at it that there's surging demand, there's limited supply, and is the uranium industry ready to support the expansion of global nuclear power? And as mentioned, globally, not Australia, but globally, that nuclear power build out and expansion is taking place. Last week on May the 23rd, the President of the US signed 4 executive orders under the Defense Production Act to scale US nuclear energy, to re-establish the US as a global leader in nuclear energy. Citibank phrased that executive order, or those 4 executive orders, as marking the most aggressive US nuclear policy act in decades. I mean, globally, this market is taking off. And if new production doesn't materialize in the near term, we're heading for a shortfall in the industry that can only be remedied by a rise in the commodity price to support new development. So when we look at price, if you look at the term price or the spot price, look at that as an incentive price, and it's simply not high enough to encourage new build outs. So if you look in our ASX, DPLO, for example, Bannerman, are ready to go. They're waiting in the wings. They just need a higher price. And in the meanwhile, they're deferring their final investment decision, or FID, until it's raised. So prices have to lift to encourage that new development and also new exploration activities around the world. Over the past 6 months, as Guy pointed out, uranium prices fell to a low of around 63.5 US per pound due to uncertainty in the world, due to geopolitically global uncertainty, whether Russia and Ukraine, or what would the US administration do with regard to tariffs and sanctions. And what that found is that the nuclear fuel buyer, or the utilities, stepped back from the market. They've typically got about 1 to 2 years of inventory of their own supply, so they can withhold market shocks. You can't simply turn a nuclear power plant on or off. So they stepped back from the market, they stopped sort of contracting in those long-term contracts, and they waited for the dust to settle. And as Guy mentioned, I mean, now that these executive orders have come through and the expansion in the US that's going to take place and is taking place, US utilities are now coming out to procure more materials. Certainly, we're getting inbound interest as well from Europe, from China, South Korea, Japan. I mean, it's just the WNFM, or World Nuclear Fuel Market Conference, that Guy alluded to next week in Sydney, is the first time in 51 years this preeminent conference has been held in Australia. And on Friday next week, we're hosting 30 fuel buyers up to the Honeymoon site. Such is the interest in Australian production, given its geopolitical stability and known as a good trading partner. So spot prices have now risen to 72 US per pound in recent weeks. But meanwhile, those term prices that we focus on at around 80 US a pound, they climbed over 21 consecutive months to December of last year and have maintained that steady position. So if you look at it both, 72 US per pound spot price, 80 US per pound term price, you're looking at some of the highest prices at the start of a new nuclear cycle. So it's really exciting, but still it's not high enough to incentivize that new production. So we feel that a price rise is inevitable. A spike will happen because of the shortfall in supply. So it's a very exciting time in the market. We're currently witnessing a revival of interest with significant midterm demand from utilities extending into, as Guy mentioned, from 2028 onwards. And Boss, well, we're in an enviable position because we're there right now. And I'll start sharing my screen, but essentially where we are with Boss is our flagship Honeymoon project is delivering and became net positive cash flow producing as we announced in the March quarter. So with spot prices, with the high quality register and spot prices rising, we feel our strategy to be ready at the start of a fuel cycle, we timed it just right. And we're very fortunate in that, but we took the leap of faith when the uranium price was hovering around 40, 45 US per pound, believing it would go up, and fortuitously, it actually has. When you look at our shareholder returns over that journey since we acquired the project in December 2015, we've basically delivered an annualized return of 38.5% each year for the past 8 years. So it's been a terrific outcome, and it's really just walking aligned with the actual commodity price itself and the market demand. But the purpose of this slide, and I know it's a busy slide, but it's to highlight the challenges and sort of milestones new projects need to wade through, and it's not easy. You've got to look at the jurisdiction. Do you have the right people? Do you have favourable government supporting uranium mining? All of these factors play an important part. But really, what we did with the low uranium prices is we walked with the market. When prices rose and it was reflected in the share price, we did raise capital. Over the journey, we've raised 430 million. But of that, we still have liquid assets on the balance sheet of around 250 million. And we've got Honeymoon back into production and a 30% stake in the Alta Mesa mine managed by Encore Energy in South Texas. When we look at Boss now, if you took a snapshot, really, we've got a lot of cash, liquid assets, primarily being inventory held in the Confidine conversion facility in the US. And we basically have there's zero debt, and we've got that net positive cash flow. So Honeymoon's wiping its face, paying for itself. We're on guidance. We will hit our production guidance of 850,000 pounds by June this year, end of next month. And really what that shows, it's quite remarkable really for any mining operation to achieve its targets within the first year. So never once have we actually changed our CapEx forecast or our feasibility forecast or our cost profile since we did the feasibility study and released that back in June 2021. Really, plant infrastructure, we're building out our well fields. The NIMP6 circuit, which is our ion exchange circuit, is working very well. And we're also looking at expansion, whether that's organic through our own exploration or inorganic, I should say, through mergers and acquisitions. But we're being very disciplined with that capital allocation, really looking for value accretive type acquisitions. Looking at sort of more in a sort of diagrammatically, Boss Energy is the only multi-mine producer listed on the ASX currently in uranium. So as mentioned, we've got the 100% owned Honeymoon uranium project in South Australia. We believe South Australia is the premier uranium state in Australia. It's got the only producing mines of uranium, being Olympic Dam, the Heathgate, and ourselves. So no other states really producing uranium now. But that just shows it's got a very supportive government. Labor's currently in power in the state, but they are right behind uranium exploration and development and production. So we're shipping uranium, we're receiving cash for that, and we're selling internationally. We're focused on Europe and US as our target markets for selling pounds, and we can look to expand that further as we ramp up our production at Honeymoon. Over the pond, really, in South Texas, we've got a 30% ownership at asset level, so at the mine level, not the topco, of Encore Energy's managed mine. It's a terrific project, arguably the best ISR project in North America, and a really terrific team involved there. And they had a bit of a rocky start with their startup. It's not unusual to have ramp-up problems, but they're on top of that now and they're dealing with it. And essentially, as Guy alluded to, you know, it's a good example where they went into contracts very early in the cycle, and with the production not keeping up, they were forced to sort of borrow or buy pounds to feed into those contracts. But they are now looking after themselves. They're producing their own pounds to feed into their own contracts. In return for our 30% ownership, we get 30% of their production. So with that, we can sell into our own sales book unencumbered, and we can feed it with our other production coming from Honeymoon. We've also got a pipeline of growth opportunities, and really around the Honeymoon mine in South Australia, we've got 2 satellite deposits known as Jason's and Gould's Dam. Collectively, that's 36 million pounds of JORC resource. We've recently finished at the end of last year an infill drill program on both of those deposits. That data sets with independent geologists now, devising a sort of block model and economic feasibility to see how viable those assets are to bring into production. But that's our near-term production. Around that area from Honeymoon to Gould's, Jason's, there's also a number of uranium hits that we've had on our tenements. So we're progressing those with arguably a very, very strong exploration team of 8 geologists, all of whom have got experience in uranium exploration. So we're continuing to generate exploration targets, but we've also looked further afield, and recently we entered into a staged earn-in agreement with Eclipse Metals, looking at one of their tenements in the Northern Territory, called near the sort of Alligator Rivers uranium field, so quite close to DevEx and Alligator Energy in that sort of zone. But it's ground that Cameco previously held from 2006 to 2008. And working with us in our team is a lady called Penny Sinclair, who was Cameco's lead exploration geologist in Australia in the last cycle. So she's familiar with the ground. We thought we'd go do a staged earn-in, which basically means if it proves to be worthwhile, we'll go to the next step, having done desktop due diligence to actually detailed exploration and drilling. But it requires deep pockets, and we've got to be really careful with the Northern Territory. But it is what we call sort of elephant country. We think that's where the big unknown deposits remain in Australia. Looking across to Queensland, and I'm thrilled to be a shareholder now of Laramide Resources. We sort of in a savvy way, and sort of over a period of time, we've acquired a position up to 19.7% of that project, with Westmoreland being their flagship asset. Westmoreland's in Queensland, terrific asset, about 66 million pounds JORC resource. There's room to expand upon it, and we honestly believe that is the best undeveloped uranium project in Australia. We know that the Queensland government's currently got a moratorium on banning uranium mining. However, the current Premier, Christopher Foley, was previously the Minister of Mines when the Liberals were last in power, and he lifted the moratorium. So what he's basically said is if there's a credible party with the right resource behind them and financial backing, then they would consider it. So we believe with Boss and our credentials with Honeymoon puts us in a good position. But in addition to that, Laramide's got projects in New Mexico, which also work with Encore Energy in that regard, and also some exploration targets in Kazakhstan. Honeymoon itself, and just to sort of emphasize how hard it is to bring uranium mines into production, it takes time. I mean, Honeymoon itself takes 50 years to get into commercial production. And really from the early discoveries in the 1970s to there, you can see the backyard swimming pool, basically, where they were trialling in situ recovery, which has only been really around in uranium for the last 40, 50 years, to David Brunt there, who's still with us in his red flares with in situ recovery. But really, the purpose of this slide is to demonstrate it's not like gold projects or coal projects or iron ore projects that can come on quickly. It goes back to, do you have the right people? Are you in the right jurisdiction? Does the resource stack up? Do you have a political stable support? Because it's all those very important sort of qualitative factors that count so much to get uranium mines up and running. And hence, you're not seeing them frequently come online. Where we are, we're really, just to re-emphasise, we're on track to deliver our guidance, £850,000, ramping that up next year to 1.6 million, and then on to the 2.4 nameplate production. We've got just on the March quarter alone, shows a run rate annualised now of 1.2 million pounds. So our NIM6 column 3 is ramped up, 1 and 2 are operating at nameplate, and we've currently got construction of the next 3 columns underway, and they'll be completed by the end of June. Commercial production was declared on the 1st of January, and by the March quarter, we were declaring our net positive cash flow, which is a terrific outcome. Our cost guidance is really pleasing too. So in our feasibility study of 4 years ago, we estimated a sort of C1 cash cost of around 18.6 US per pound. And here we are 4 years later with all the inflation that we've incurred since COVID and still getting around 21 to 25 US a pound. So if you go back to spot prices at 72, term prices at 80, to have those sorts of C1 costs makes this a very profitable project. So, we're continuing to drill, we're continuing to explore, and we're going to update the market in the coming quarter with our mineral resource update for Goulds and Jasons and how that can feed into the production profile. And they're just in a bar graph, really just showing the growth. And in the orange bars, you can see the sort of drummed uranium and how that's been picking up. So, almost quarter by quarter, it's doubling, and it just is testament to the plant working optimally, having adopted ion exchange as the process technology that we're using. In terms of just pictorially looking at the columns itself, they're the first 3 columns, 1 to 3, left to right, and now you've got 4, 5, and 6 being built. That's a photo taken 3 weeks ago, and we're now at the top level, similar to what's in the background. So yeah, construction's going really well, and that big yellow crane sadly is coming to the end of its useful period that we need it for. But we actually built this project self-performed. So we didn't go out to EPCM, pay the additional 30% premium. We actually employed our own Australian engineers, our own Australian construction workforce, and we've built it really with most of the products coming from Australia. In fact, 95% of our expenditure is Australian domiciled expenditure. It's only the resin beads that we import. So very much a proud Australian development. Looking at well fields and what we're doing, if you can see the sort of blue outline, that's the box mining lease that we're in. That mining lease hosts 36 million pounds. So in addition to that, the satellite deposits hold 36 million pounds. So collectively, you're looking at a 72 million pound resource potential. The 3 domains that we call it in our sort of geology perspective, we're focusing right now on the centre Honeymoon domain, but then we're branching out to build well fields in East Kalkaroo as the second domain, and then Brooks Dam as the third domain. So a lot of well field activities taking place, but essentially they just keep rolling out, and we stay about 6 to 12 months ahead of schedule in terms of well field development. So right now we've got clear line of sight for the next 18 months with known well fields sitting over known resource, which is terrific. So it's really now we just manage ourselves with the commodity price. I've talked about exploration, so I won't spend too long, but just to show you on a map, Honeymoon Mine is situated here, about 15 kilometres to the north is Jason's deposit, and then about 80 kilometres to the sort of northwest is Goulds Dam. We've also got some tenements to the south that we call the Kinloch properties, and we're actively exploring there. So these deposits really do have that potential to drive the company forward, to increase the actual production, annualised production up to 3.3 million pounds, which is our federal government endorsed export permit, or extend the life of mine, or a combination of both. In terms of Alta Mesa, our plant in South Texas that we own 30% of, there's a picture of it, and it's different. It's an alkaline solution rather than what we use with acid, but very effective, and that plant's running very well. Where they got caught up was not developing well fields quick enough, but they've addressed that issue. They've now got 22 drill rigs on site and actively speeding up the well field deployment. Looking at them, we had the official opening with President Bush in October. Their first 2 ion exchange circuits are now up and running, and their wellfield solution head grades are coming in very respectably at about 65 to 140 ppm, or parts per million of uranium, which is very, it's very respectable within the industry. They've captured about 50,000 pounds in the March quarter, of which we get 30% to sell into our own sales mix. And they're now really ramping up to that production name rate of 1.5 million pounds. So once they are at that level, we get sort of 30% of that, 450,000 pounds on an annualized basis in the US, where US production only accounts for 5% currently of US's demand, let alone with the executive orders and further growth in that nation. So yeah, wonderful to be partnering with a US production producer. So I'll just touch on market update. I know Guy covered this quite extensively, But I think when you look at it, this dotted green line really shows where the term price is and the spot price. And what's fascinating is that the term price actually recently with the exchange rates are the highest in Australian dollars it's ever been in the history of uranium. So wonderful opportunity for an Australian and US producer coming onto the market. The orange line represents the spot price, and you can see occasionally it shoots up higher than the term price. When it goes too quickly, you find that the term price lags by about 3 or 6 months. If it goes too quickly, fuel buyers typically step back and wait for it to calm down because they can rely on their own inventory balances. But meanwhile, as the spot price continues to rise, the lagging term price follows. And, to stay at 80 US per pound is quite something over the past sort of 6 months. So very, very exciting. It's exciting that uranium's exempt from US tariffs, and the US is really pushing the nuclear debate now and an expansion of conversion facilities and enrichment. And really that's bodes so well for a geopolitically stable producer such as Honeymoon in South Australia. So Jane, with that, I'll finish up, and happy to take any Q&A if you like.
Yeah, absolutely. And Duncan, it is great to see that Boss, is on track to deliver that production and guidance at Honeymoon. So we will jump into some questions. And again, webinar attendees, please use the Q&A function, which can be found at the bottom of your screen. We are running over, but I'm going to jump into it. So the first one looks a bit educational. So regarding Honeymoon, and again, well done on achieving commercial production, can you walk us through some of the key technical or operational decisions that were most crucial in achieving this milestone? So maybe perhaps for some that are not so across how production works compared to other commodities, just give us a bit of an example there.
Sure. So Honeymoon is a restart project. It previously operated, produced, sold uranium around the world. But when we acquired the project, the uranium price was around 18 US per pound. So it was very low on the back of Fukushima, and the plant simply wasn't economically viable to run at that point. So we then did a detailed assessment of the project, and what they were using in their processing plant was a method called solvent extraction. What we changed it to was ion exchange. So we basically simplified the processing circuit to make it more efficient and cost effective to produce uranium. So introducing ion exchange was the key driver for our technical advancement. We did that with ANSTO, Australian Nuclear Science Technology Organisation. We did it with local consultants, and worldwide we had independent experts advise us. But that definitely has lowered the operating costs and increased our production throughput. In addition, we looked at our well field. So we, with more modern drilling and techniques, we're able to, and picking up off what Kazakhstan was doing, Kazakhstan really became prominent in the last cycle with their in situ recovery. So after the original Honeymoon was built, but really we adopted new well field strategies. So better placing of the screens under the ground, changing the actual lixiviant, which is the fluid which sort of leaches the uranium. So we increased the level of acid. We introduced ferric as an oxidant, and the combination of that with our groundwater supply works very well. So yeah, it was largely looking at the well field, changing the plant design, and also just getting the right people on board.
Yeah, absolutely. Look, a couple of questions here just about the pricing of uranium. So just regarding the uranium market, how are you thinking about contract pricing versus the spot market? So perhaps maybe just a bit of a summary on the market itself.
Yeah, we've been really disciplined in contracting. We didn't want to rush our contracting. We believe that fundamentally the uranium price has to go up to incentivize new projects to come online. So it's similar to what Guy was mentioning, it doesn't make sense for new producers really to contract their whole book or their project right up front. I mean, where's the blue sky with that approach? So what we've done, we've contracted about 3.5 million pounds, roughly 17% life of mine, predominantly in these early years, so 25, 26, 27. And we will keep contracting, but we're going to be very disciplined about it. When we enter into contracts, typically they're a hybrid contract. There's a level of fixed pricing. There's a component of market-related pricing with a floor and a ceiling. And so that's typically how we're going to go forward. More recently, what we've been doing is sort of carry trades, really selling 3 months or 6 months in advance. For example, when the price was around 65 US a pound, we were able to forward sell 6 months in advance at $69 US a pound. So what that does, it allows us to keep being sustainable and a going concern, but it doesn't bind you up for 5 years into a contract. So it's just a more savvy way. We're nimble and we can be quick. It's not like Cameco, for example, that has 20 million pounds to find homes for each year. They have to contract. That we can use the spot market to our advantage with that carry trade, only selling to utilities, and it seems to be working for us.
Duncan, look, and there's a couple of questions, in fact, actually, that came through before today's presentation, just about Boss's portfolio. So assets, growth options, which I know you've gone into a little bit today, but I might just ask more broadly, whether it's South Australia, the Northern Territory, the United States, or even Kazakhstan, with your experience, which do you see offering the next best sort of opportunity to come into the market?
I honestly, if we had the right government policy, Australia, we've got a third of the world's resources, Western Australia, Northern Territory, Queensland, for example, wonderful resources, wonderful opportunities. So I really think Australia, if it could lift or change the political environment in which we operate, would be amazing. But from our purpose, what we and our shareholders are really focused on is to be a stable Western producer. So by that, we're really focusing ourselves on M&A activity or growth within Australia, North America, and Canada. That's our target market. There's wonderful projects around the world, not discounting that, but that's where we are currently positioning ourselves in those countries.
Duncan, I think we've gone over time here at the moment, but if we've missed any questions for Duncan, please feel free to reach out via info@janemorganmanagement.com.au. But Duncan, I really appreciate your time.
Thank you. Thanks very much, Jane. Thank you.
So next up, we have Pete Moorhouse, who is the Managing Director of Basin Energy with the ticker code BSN. Basin is a green energy metals exploration and development company with an interest in 3 highly prospective projects positioned in the southeast corner and margins of the world-renowned Athabasca Basin in Canada, and it's recently entered into agreement to acquire a significant portfolio of green energy metals exploration assets located in Scandinavia. So to tell you more, I'm going to hand you over to Pete.
Excellent, thank you, Jane, and thanks, Guy, for the exceptional preamble there. It's an exciting time to be in the space, and I think everyone on this call will be very excited, I'm sure. I'm here to talk to you about a bit of a gear shift here. So we've had Boss talking about production. I'm going to take you through some exploration insights, what Basin Energy has been doing, and my thoughts on exploration jurisdiction. Okay, so we should have a screen share going. Disclaimer, this release will be available for viewing on the ASX on our website as of tomorrow, so please feel free to read that at your leisure. Now, Basin, we are, I would argue, from a market cap explorer's point of view, one of the most uranium skill-setted board and management around. My background, I'm a geologist, and as a lot of you will have heard me talk before about uranium exploration, but really that's been our forte. The technical drive comes from O'Deal, so O'Deal's ex-Orano, significant time looking for uranium in northern Africa and also northern Canada. And then Blake and Corey with extensive experience in the US. Blake and Matt themselves involved with Azaga, who was sold to Encore Energy back in 2022 for some 200 million, as Duncan is discussing some of the Encore experiences just a minute ago. Now, with that, it gives you a bit of a strong set of criteria for strategy. So when I talk about exploration, we're talking about why Basin is exploring where it is. And it's really, there's some fundamental points which I think everyone needs to be aware of. One is jurisdiction. Jurisdiction keeps popping up here. But operating in areas where there is an active mining industry, preferably where uranium has been mined and explored, and there's a policy in place, there's a clear framework for both exploration but also through to development. Having a clear exploration strategy, so understanding what the model you're aiming is, but also ensuring that you have a model which is explorable for your scale. So whilst there are some phenomenal deposits to be had in the Athabasca at 1,000 meters depth, it is very, very difficult for a small cap explorer, especially in the markets we've seen over the last few years, which is why we're pretty excited about our holding both in the Eastern Athabasca, which we'll talk about in a minute, but also our shift into Scandinavia. Project maturity, so ensuring that you have enough data to get going and a way of adding value to your projects relatively quickly, but also that you've got space. So going and doing the same thing that all the previous explorers have done and expecting a different outcome is fundamentally wrong. So ensuring that you have a different strategy and enough room for a credible discovery. And using that knowledge and that criteria to unlock other opportunities. So not being afraid of looking where potentially others have not been looking in recent years. Now, Basin itself, as I mentioned, we are a very small company. We are an explorer, and we currently have 3 assets in the Athabasca Basin, which is what the company was IPO'd on about 3 years ago. And we also have a portfolio of exploration licenses in Sweden and some reservation ground in Finland as well. So all Northern Hemisphere at the moment, and we believe in some pretty exciting jurisdictions and some strong explorability. Now, I'm not going to do my full Athabasca talk. A lot of you will have heard it, but I just want to outline where we are sitting there and why we're so excited about what we have done and why we think this holds an intrinsic value moving forward. So we have 3 projects in the Athabasca, North Valley and Marshall, and now we are exploring for what we call traditional unconformity deposits here. Now, these are a bit deeper targets, and we have done the least amount of work on. And then we have the Geeky project, which we're targeting what we call basement host mineralization. Now, this is really leveraging that geological framework we were just discussing, having a shallower opportunity, potentially an opportunity which was really overlooked since the discovery of the NextGen's Arrow deposit back in 2013-ish, so 12, 13 years ago. Now, the Athabasca Basin, northern Canada, is home to some of the biggest, most highest grade uranium deposits around the world. Now, with this, you have that jurisdiction, you have that understanding of uranium market operations, and an acceptance with both government and with local socials. This is home to the likes of Cameco, the likes of Orano, and we believe that this holding that we have in this area is phenomenal. I'm going to talk to you about Geeky primarily, so this is the work that the Basin's been doing. Now, as I mentioned, we're targeting what we call basement host mineralization, which has been overlooked significantly until we took over the project. So historically, a little bit of baseline work, enough work to prove rock type, enough proof to prove structure. We did a series of geophysics and we did 2 drill programs on it. And it's left us in a position where we've tagged what we believe is a significant system, and we have no shortage of targets to continue and follow up on there. Now, quick geology, these are 2 different comparisons for drill cores. So the green box is drilling at Geeky, and the box to the left is drilling from other major basement host mineralization systems in the world, or in the Athabasca, I should say. Now, these systems have a very specific set of alteration patterns, and what you see at the top here is alteration from the Arrow deposit. We've got alteration from the GMZ by Arthur Energy, formerly 92E, which some of you will be aware of, the Rough Rider deposit. And then we have what we've been tagging at Geeky. So you're in one of these systems, these alteration patterns are dead ringers, and you've got the scale as well. You've got tens of meters of these pervasive clay alterations. But we drilled this last year and we didn't hit any raging grade. We got evidence for metal. We got up to just over 0.25% uranium. So we know that there's uranium in the system, and we know that we have an active system at play here. Now, that leaves us with what next there? Well, the best vector we've found for tagging this and mapping this has been using gravity. We've got a series of gravity anomalies sitting. We've only just started to test them. There's no shortage of targets to put this rig out. We're in an area of emerging recent exploration success, for example, baseload energy, and I mentioned Arthur Energy a moment ago. These gravity features appear to be representing these alteration patterns, and we know that we can be just a few meters away and be missing that grade. So no shortage of targets to drill test. Again, from a project maturity, there's plenty of space here. There's some really solid fundamental data, and you're in the right jurisdiction on the edge of what is the world's premier uranium district. And an active policy to be pushing SMRs forward as well. Now, there is, recently was permitted a uranium processing circuit in Finland, and that started to commence production back in 2024. However, Sweden does have an active ban for uranium mining in place at the moment. Now, that was placed in 2018. It was under review from 2022, and an inquiry recommended lifting that ban towards the back end of last year. And we're expecting some news on that over the coming weeks and months. So pretty positive from reopening an industry for uranium extraction in Sweden. Why did we go into Sweden? Well, we looked at what we were identifying in this basement host mineralization in the Athabasca, and we were looking for opportunities elsewhere in the world. And we saw these historic uranium districts in northern Sweden specifically. Now, these are part of polymetallic districts. So we've got some of the majors operating in exploration right next door to us. We know that there's some VMS opportunities just to the south. So it's a true polymetallic district, but historically was explored as a uranium area as well. Hasn't really been looked at since the 1980s. So we kind of looked at this and, well, geologically, what have we learned in the Athabasca over the last 20 years? What do we think from a prospectivity for multi-commodity, green energy metals moving forward, and realised that there's a real opportunity here. We hold, just to mention that, there's a reasonably large area of holding, 200 kilometres squared of land, of areas, and really only 3 focused areas of drilling. And these drillings are really tight space. So Verka, for example, there's drilling in the space of 300 by 300 metres, and they hit some mineralisation. The same at Raba and the same at Bjork. We picked this ground up. We've gone and done some initial mapping and done some initial sampling, picked up rock chip samples away from that historic drilling, both in situ and in float, running at several % grades of uranium. Also some really interesting rare earth results as well, with some strong heavy metal concentrations, heavy rare earth concentrations as well, and some fascinating zinc numbers. But critically, these occurrences that we've picked up are away from those historic drilling areas. Now, the drilling targeted where outcropping rocks existed. So what our logic here is, okay, with modern exploration, our recent understanding, with geophysics that we have available, what opportunities can we see sitting directly underneath these thin veneers of glacial covers around these prospect areas where you know you're in a fertile system with some really, really exciting grades. Now, the big advantage is there's also a lot of drill core in this area. Drill core from drilling at Bjork, drill core from Rava, and drill core from Verka. And it's very well preserved. So from a junior's point of view, it's free data. The guys have been pulling this apart from a geological perspective and extrapolating, okay, well, how can we use this for targeting? And we've consolidated our land position around those drilled areas to take out what we think is the most prospective. And we'll continue to roll out that exploration strategy where you're all looking at shallow hosted, potentially reasonably good grade mineralization for commodities which are going to be absolutely essential to Europe over the coming years. So that's our position in Scandinavia. Very quick overview, but I am very conscious of the time. So perhaps we've crossed over to any questions there, Jane?
Yeah, absolutely. And of course, every time we do this event, we do tend to run over time because Guy doesn't give us a big overview. Look, I'm going to jump into it now. So regarding the Athabasca project, you touched on results from Geikie, but didn't talk about Marshall and the North Millennium project. So just a bit of a brief overview on those.
Yeah, absolutely. So we've got, as I mentioned, there's 3 projects there up in northern Saskatchewan. Now, the Geikie project was targeting what we call the basement mineralization, whereas North Millennium and Marshall were deeper sets of targets. Start off with North Millennium, we ran some ground EM over there, and we're struggling to pull together a drill-ready target. So that's one that we're going to put in a little bit of a, let's think about this from a different perspective. There's no major conductors. However, 100% owned Marshall project next door, we ran ground EM on and found what we found a set of what we call stack conductors, where we get anomalism both above and below that unconformity we mentioned. Now, this is a pretty exciting target, but it is deep. So we're talking maybe 700 meters target depths there. So you're going to be drilling 800-meter holes, which is very difficult for a group like us. It's a very credible target. We've got a runway on that, but that's an opportunity that we're looking at releasing value from elsewhere with the company moving forward. So yeah. At the moment, the focus that we believe we can add most value to is on those shallow opportunities at Geikie and with the basement hosted stuff in Scandi.
Well, just on that then, so you've walked us through Basin's recent expansion into Scandinavia. Can you provide a little bit more detail on the strategic rationale behind this move and how these assets fit into the company's broader growth plans?
Yeah, absolutely. Look, from our perspective, you're always looking for those opportunities where you think you can add value and build from in the position that you're in. So we identified this using that skill set and that criteria that we outlined a moment ago, and going, well, the Athabasca is exceptionally tightly held for those credible targets, and it has been for a significant period now. We're very proud of that ground in the eastern side, but it is remote and it is hard exploration, so we're not shying away from that. But to expand that holding in the Athabasca for those sorts of targets is very difficult. So our narrative here was, okay, we can do this. We can be a relatively early mover into Scandi for a similar model, take out a reasonable amount of land for a relatively low cost, and be able to add value at a relatively low price point. So being able to do that groundwork, that mapping, that looking at old core, that resampling, and then being able to drive into these assets as well. I mean, there's forestry tracts across the vast majority of them to then be able to explore from a cost-effective point of view. It's opportunistic. We like it because it's something different, but we believe that there's a serious way forward to put some value onto that for us.
Yeah, absolutely. Look, and I think we've heard a lot today from, all the presenters that have been speaking, but the global demand for uranium is forecasted to rise over 200% by 2040. And nuclear is increasingly being viewed as the cornerstone of this energy transition. So how is Basin positioning itself to capitalize on this momentum, particularly as governments in regions like Scandinavia and North America re-engage with nuclear policy?
Yeah, absolutely. So establishing yourself with that key ground, as both Duncan and Guy alluded to there, that there is a series of projects that can start to ramp up when we see that price move, but then there's a big gap. As Guy said, there's been very little real exploration for 15 years around the planet now. So we see that Basin has an opportunity here to establish themselves for the ASX as a investment opportunity for this, sure, risk capital, but exploration phase of this cycle, which, as you know, if you get right, is phenomenal. That strategic moves to pick up ground, which you can add value to and you can explore in jurisdictions which we believe will be or are supportive, is really the positioning there. And it's going to be an exciting few years ahead, and what a time to be in uranium. So,
isn't it? Absolutely. And look, I think just finally, shareholders thinking about near-term milestones, what are next steps they should be looking at?
Yeah, okay. Obviously, there's the work that we're doing at the moment. So the guys are, it's not. The guys are in the sheds at the moment, looking at that core, assaying that core, setting up the models for how to move that northern Scandinavian projects forward. We've got a series of samples in the lab there as well. We've managed to acquire quite an extensive historical set of geophysics as well, so using that and getting that into a modern standard and doing the relative QA/QC on it. That's going to direct our immediate moves in Scandinavia. Potential other ways of releasing value for our unconformity targets in Canada as well is one that we're pushing actively. So there's a lot going on, and we look forward to updating the market over the coming weeks and months as to what that's going to look like.
Absolutely. Pete, thank you so much for joining us today. Copies of today's recordings will be available online in the coming days. And if we have missed any questions, please feel free to reach out by the contact details on the bottom of the ASX releases. But Pete, thanks so much for joining us.
Thanks again, Jane. Really appreciate it.
So next up, we have Andrew Ferrier, who's a Managing Director at Global Uranium and Enrichment with the ticker code GUE. The company has strong strategic positions in North America's most prolific uranium districts, the Powder River Basin in Wyoming and the Tallahassee Creek Uranium District in Colorado, as well as the Athabasca Basin. MST actually published a note with the valuation, I think it was a couple of days ago, with the valuation of 23 cents a share, which is a lot higher than what the current share price is. So to tell you more on why it's such a good investment, I will hand you over to Andrew.
Thanks, Shane. Really appreciate the opportunity to speak about global uranium. I think it's, as other people have mentioned, this is impeccable timing, particularly for GUE. And I think about what global uranium has achieved over the last 3 months to set itself up for exactly this sort of macro and political background that we're seeing. We're incredibly excited about the future. So global uranium has always been focused in North America. We started the year with 52 million pounds at our Tallahassee projects and our other project in Maybell, which we're still working on. And I look at what we have in the portfolio today. We went out and brought one of the best projects in the Powder River Basin of Wyoming. Powder River Basin is the heartland of ISR, in situ recovery in the US. We've got a fantastic project in a fantastic location, 15 k's from Cameco's mill, and we have a very substantial exploration target on that project today. On top of that, and Guy alluded to this, we now have Urenco investing into our enrichment technology company, which is Uranium, which GUE is the largest shareholder of. That is an incredible validation point for the company. It creates an incredibly interesting company moving forward in terms of that technology being developed. So that in itself is an incredible milestone that the market really hasn't caught on to yet. But let me walk through the presentation and detail that in some detail. But your point is spot on. MST came out with a report earlier this week that a price target of 23 cents. We're currently trading at closer to 7 cents. The value in this company is profound today. If you want exposure to everything that's happening in the uranium space, and you want that exposure to be in the ASX, there's no better company than GUE. It's simple as that. There are not any other companies on the ASX with US projects, number one, and an investment into an enrichment company. So we've set ourselves up perfectly to move forward, and that's been very deliberate from our side. Our strategy has always been to grow in the US. I've been a part of the company for the last close to 2.5, 3 years, and we've systematically looked at projects in North America in that time, and we've gone very big into it in a project called Pine Ridge, which is the project in Powder River Basin that I spoke to. And during that time, we brought on a pretty substantial shareholder onto the register as well, which is Snow Lake, which is a NASDAQ listed company. They've came in as our JV partner on Pine Ridge as well, when we're very excited to have them as an extremely supportive shareholder moving forward, which is going to help us rapidly develop this Pine Ridge project in the US. So Pine Ridge, we have an exploration target of there of 24 to 51 million pounds. Even if we hit the lower end of that 24 million pounds, that's going to be one of the biggest projects in the Powder River Basin in Wyoming. There is no more supportive jurisdiction in the world than Wyoming. It's had a huge amount of historical production. There's production coming out of it at the moment. The government behind Wyoming, its senators, its regulators are all very pro-development, irrespective of what came out from the administration earlier this week. This is the place where you want to be building a uranium mine. We are one of the better ones. As I mentioned, Uranium now has Urenco. We've announced that transaction. That transaction we expect to be closing in late June, so around 4 weeks from now, and that is a huge value milestone for us. I'll touch more on that as we get into slides. And then on top of that, we'll put out a scoping study on our Tallahassee project. Tallahassee is in Colorado. It's one of the largest undeveloped uranium projects in the US. That's going to be pretty handy when the president comes out and says we're going full nuclear. We're going to triple, quadruple nuclear in the US, and we want the uranium to come out of the US. To achieve that, you need big uranium mines. Tallahassee ticks all those boxes. We just put out a scoping study. It is fabulously profitable. As Duncan mentioned, the term price is $80 per pound now. You look at the torque that project has when you start getting north of $80 a pound, and it's an incredible moneymaker. But looking at the executive orders, these have been touched on. Basically, the US has gone all in on nuclear. There's no other way of putting it. It was already a bipartisan issue before the Trump administration came into power. Things like the Inflation Reduction Acts, which came in under the Biden administration, were hugely favourable to the nuclear industry, particularly in the enrichment space, and particularly to the US utilities to basically give them tax breaks to keep them ticking along for the next 20, 30 years. What Trump's done is he's basically doubled down on that in a very, very Trump manner. And what he's basically saying is the US used to be a world leader in nuclear. That fell away. We need to bring that back immediately. And he's basically given pretty strict instructions about how that can occur and how that's being funded. But the outcome for us as ASX, as a company with US projects, is the US is just going to need more domestically sourced uranium. And we're in a perfect position to be able to take advantage of that moving forward. And this is before this map on the right. This was touched on previously, but even just under today's constructs, the US produces a fraction of the uranium. The US is the biggest nuclear power today. It's got a minuscule amount of production. So even before they're talking about rapidly expanding their nuclear capacity, it was still a chronic issue back then that the US needed more production to come out of the US. So this is just compounding on an already huge structural deficit in the US. And again, I'll move on to now why we're so well positioned. These are our portfolio of assets. The Pine Ridge projects in Wyoming. The team I have a huge amount of experience in Wyoming, including myself. We permitted a uranium project in 2018, which isn't that long ago, one of the very few projects that's actually been permitted in the US over the last couple of decades. We have that skills, we have that experience. This Pine Ridge project is 30 kilometers away from that project. We have already a very good relationship with the ranchers. We have a very clear idea of how we're going to rapidly advance this project. But to give you a snap of Pine Ridge and why we like it so much, the position we've picked up there is in the sort of two different tones of blue that you can see. It's a huge project. It's not too far from Casper, which is a big industrial hub in Wyoming. It's directly south of Cameco, which is their Smith and Highland Ranch projects. They produce uranium out of the Smith Ranch mill, which you can see there down here to the south, until around 2016, 30 million pounds of uranium have come through that mill. It still sits there today. It's obviously in care and maintenance, in very good nick, and obviously a hugely important piece of infrastructure in the US moving forward. Our projects, as I said, a huge amount of work has been done over the last 10 to 12 years. We acquired this project from a private company in the US, and it really was one of the very few projects of genuine scale that was remaining in the Powder River Basin. Everything else had been consolidated over the last 2 to 3 years with the run up in the uranium price. We're aware of the opportunity. We worked very close with the vendors to get them comfortable with who we are and what we wanted to do with the project. They obviously want to see it advance as quickly as possible, and that's exactly what we're going to do. So we've got Cameco to our south, UEC to the north. UEC is who we sold the Ferrier Craib projects to. Is the project I referred to as the one we permitted back in 2018. So we understand the landscape very clearly here, and we know how to advance this project rapidly. And it's not an exploration project, right? This project has over 1,200 drill holes in it. We only have an exploration target on it today and not a resource, and that's purely just a function of the previous owners and what they wanted to do with the projects. They wanted to show the district scale of it, which it is. It's incredibly big projects. To drive around this thing takes all day, as we just had people decide today in the US doing with the team. There's a huge amount of roll fronts on this project. Roll fronts are basically, you know, the front of the mineralization. We're going out and going to drill this project extensively this year. We plan 125,000 feet, which is 40,000 meters. And basically this has been set up perfectly for us to run in, drill on those roll fronts that have been identified by the previous owners, and pull together a resource on this project. And that's exactly what we're going to do in the second half of this year. From that point, we'll put out a scoping study on this project, probably very early next year, and then we're going to run straight into advancing this project through permitting and into production. This is the perfect environment for a project like this. Every box is now being ticked, and it's 15 k's away from a mill sitting in care and maintenance. So we got our timing perfectly here. We know what we're doing. We've got a team, and it's the right jurisdiction. I have to touch on Uranium. I know I've already mentioned it. Uranium is a chemical uranium enrichment technology. It's a private company. It's based in Australia. The information has been classified by the Australian government. We, Global Uranium, invested in this company a little over 2 years ago and feel incredibly validated from that investment. The technologies continue to improve. We announced in a previous announcement that they're at a level called TRL4. TRL refers to a technology readiness level, which is a very broad spectrum of explaining generically all technologies where you are in terms of commercializing that. And 4 out of 10 doesn't sound very impressive, but I can promise you that is a huge advancement for the company, and you can benchmark that against other enrichment companies to get a sense of where this company is and how rapidly it was capable of moving up those technology readiness levels. Again, we announced that Urenco, which is the Western world's largest enrichment company. They have enrichment facilities across the globe, including the US. They have an enrichment facility in New Mexico, which is the only real commercially available enrichment facility in the US. The US is also chronically short enrichment capacity. Bring those guys on board is a fantastic outcome for the company. We're obviously working to close that transaction. Uberian and hence GUE will come out with more details about that collaboration going forward as soon as that deal closed. But incredibly excited about it, and largely not valued by the company. It's just not valued yet in our share price, which is frustrating, but obviously will be rectified shortly as we continue to put news out to the market. So we sit there in incredible tailwinds. Like people talk a lot about the spot uranium price and the term price, as Guy and Duncan and Pete did. If you look at the enrichment price, it's gone nothing but up, right, since the Russians invaded the Ukraine. Enrichment, when the governments talk about what they need to do to secure nuclear energy supply, nearly all of it's focused on enrichment. So we're in incredibly a fantastic spot. We've invested, we're the largest shareholder with fantastic technology, which is attractive, one of the best enrichment companies going around. So we're very excited about how that's going to play out in the future. So I won't touch too much on a corporate overview, but basically, sorry for jumping around. Basically, we've got fantastic assets in the US. We've got our Pine Ridge projects, which we're going to drill nearly starting probably early July, drill for 4 months non-stop. We just put out a scoping study on our Tallahassee project. It shows it's a project of significant scale that has huge torque to the uranium price, and the US needs a whole bunch more uranium. So we're perfectly positioned. We have a team that knows what they're doing. Jim Villeneuve and Tim Brown, extensive experience both in the US and in the uranium space. We now have Snow Lake in as a 20% shareholder. Frank has joined our board. He's the MD of Snow Lake. They bring a huge amount of skills and expertise, but also financial help in terms of closing the transactions we did at Pine Ridge. And we're going to be running very hard these projects moving forward. So I'll sort of end it as I started. I generally believe that GUE is the best way to play uranium moving forward. The action is in the US. We've got US projects, and we've got good ones which we're moving forward rapidly. So I'll leave it there for questions.
Wonderful. Thank you so much for that, Andrew. And yes, once again, if you do have questions for Andrew, please use the Q&A function, which can be found at the bottom of your screen. I'll kick things off first up. So you've obviously walked us through Pine Ridge, and you have mentioned this in your presentation, but just to recap, why Wyoming and the Powder River Basin are such compelling locations for GUE right now?
Yeah, it's a great question. And all the guys previously spoke about the importance of 3 things, like people, resource, and jurisdiction, right? We have the people. We're permanent uranium mine before we know what we're doing. In terms of the Powder River Basin, it's been the uranium heartland since the 1950s. Over 250 million pounds of uranium have come out of just the Powder River Basin. It's an ISR jurisdiction. So the Pine Ridge project is in situ recovery. That's where our skills and expertise is. That's the pathway that we want to take moving forward. ISR projects are fantastic in the sense of they're very nimble. They're relatively low capex to get into. So it's not when we're talking about any huge mills. We've got Cameco's mill down the road. So it's a very simple, well-known process. It's long been established in this part of the Powder River Basin for a long, long time. Companies like USC have started up in the Powder River Basin as we speak. It's going to be their hub and spoke strategy is going to be an important part of bringing uranium pounds into the market in the US. Wyoming is an agreement state, their own state authority, which is the WDEQ, are very helpful. We know the people in those buildings extremely well, and they're pro helping us move projects like this moving forward. So we think there's no better spot than Wyoming, and we're glad to be there.
Bear with me, Andrew. I'm jumping around a little bit here. You just mentioned, obviously, the players in Wyoming like Cameco and UEC. What gives GUE rather a competitive edge in this region?
Yeah, it's a good question. So obviously, groups like Cameco and UEC, well, Cameco for a long time, but UEC as a company actually got into the Powder River Basin, in 2018 through the acquisition of a Reno Creek project, and I know well. Then they brought the Uranium One assets with the Russian-owned assets in the Powder River Basin, and has continued to build its projects. Where we have our competitive advantage is basically the skill set of our guys. There's no way, given our market cap, that we could have landed a deal like the Pine Ridge deal without us being able to go into Wyoming, go into Casper and talk about our experience and backgrounds and what we've been able to do in the region, how we deal with the landowners, the ranchers, how we deal with the regulators, and how we actually know what ISR is. Like the formations that the uranium sits in the Pine Ridge Basin, in the Pine Ridge project, is exactly the same formations that we're dealing with Reno Creek. So the exact same rocks. We know what to look for. We understand that, and that skill and expertise sort of sets us apart. And obviously, being smaller, we're a lot more nimble. We can move quickly. We see opportunities. We can chase them pretty hard.
Thanks, Andrew. And look, another one's popped up. So of the 449 holes that the vendors drilled, 229 hit uranium mineralization. So will the company be infill drilling around these existing hits in the upcoming program?
Yeah, it's a fantastic question. So it touches a little bit on the type of drilling that the existing vendors, the vendors we acquired the project were doing. They were essentially doing step out systematic drilling, right? So they were just literally trying to map the roll fronts, and they actually weren't too concerned if they were hitting uranium mineralization or not. They were essentially trying to work out how big this project was, not exactly where the uranium was. If I know that's a bit of a simplification, but essentially they were saying this is a massive project. It sits over 70,000 acres. Where is the uranium and how far and wide is it? And they basically did that drilling to understand what that looked like, and they did fantastic jobs, and excellent geologists worked on the project, and the work that they've handed over to us is gold. What we're going to go in and do is, great guys, you've worked out where the uranium is. Well, we're basically going to go in and, as you said, effectively infill that on the roll fronts and basically build out pounds under pattern and build out a resource based on the pretty extensive exploration target we have.
Andrew, we're running out of time, but just finally, so shareholders thinking about catalysts, what should they be keeping an eye on?
Yeah, it's a good question. So what we're working on right now on the catalysts are in the sort of next 2 to 3 to 4 weeks. One is just getting our permit at Pine Ridge to go drill, working on that. That's all going extremely well. Second one would be closing the Urenco investment into Uberian. That would be a big outcome for us, and there'll obviously be associated news flow with that. And then come early July, which is, oh my gosh, only 4 weeks away, we're going to be non-stop drilling on our Pine Ridge projects. So there's going to be a huge amount of news flow. We've set ourselves up at the start of the year to allow this to happen. So that will just continue to feed the beast and put news out into the market.
Andrew, thank you again for the update. Very exciting times for you. And again, if we've missed any questions, which we definitely have because we've run over time, but please feel free to reach out by the contact details on the bottom of the ASX releases or to info@janemorganmanagement.com.au. But thank you again for joining us.
Thanks, Shane. Appreciate the opportunity.
Okay, so our final presenter for today, and Phil, I'm so sorry. I know you're in London at the moment and we have sort of pushed along a lot longer than we thought we were going to, but we have Phil Mitchell, who is the non-executive chair of Aura Energy with the ticker code AEE. Aura Energy is an Australian-based mineral exploration company with major uranium and polymetallic projects in Africa and Europe. The company is focused on developing a uranium mine at the Trias Uranium Project, Tirias rather, and major greenfield uranium discovery in Mauritania. Phil, I'm going to hand over to you.
Look, Jane, thank you for hosting this opportunity and for encouraging a group of pretty interesting people to come and talk to us. I think Duncan's gone off to do something useful, but he needs a hearty congratulations for coming to market exactly at the right time, and he's ramping up nicely. Guy, thank you for your introduction and industry overview. I think all of us are pretty excited about being in the uranium industry at the moment, and for Aura, we're a near-term producer. We are ready to go at Tiris in Mauritania, and we're sorting out some money, and so we're hoping to be chasing Duncan into production pretty soon. Jane, do you want to go through to the? Yeah, let's go to the next one. So we're listed on the Australian Stock Exchange. We have a market cap of about 125 million with about 1 billion shares on issue. We have 2 projects, Tiris in Mauritania. The project is 85% owned by us and 15% owned by the government. It's a 93 million pound resource, and we've done the feasibility study, we've done the feed study, and we're just polishing off capital costs and polishing off fundraising at the moment. We also have a very large project in Sweden. I'll talk a little bit about Sweden later on, but I'm pretty excited. And somebody mentioned earlier that Sweden has banned uranium mining for the last few years, but the government has said recently that it's going to change that existing ban, and that will probably happen on the 1st of January 2026. The legislation's being prepared. Our team were with the Swedish government and at the Parliament last week, and very positive messages. We think the ban will be lifted on the 1st of January 2026. So two very interesting projects. And Jane, if you go to the next slide. Guy has taken us through the industry position. Oh, no, you can move on from that, Jane. Guy's taken us through the industry position. You can see the supply gap that comes from the WNA forecasts. People have talked about 61 reactors, talked about the reactors that are in operation. But one area that we haven't had a proper conversation about is energy intensity. And if we look at China energy intensity, the number of gigajoules per person per annum, we're at about somewhere between 50 and 100, whereas in the United States, we're at between 300 and 400. But in India, we're at 15 to 25. In most of Africa, we're less than 20 gigajoules per head per annum. Picking up 20% of those differentials on India and Africa, just 20% from nuclear really expands the game out, and it's not included in that supply gap. So it's a very interesting place to be. Next slide, Jane. Tiris. So Duncan spoke a little bit about jurisdictional support. He spoke a little bit about resource. He spoke a little bit about the project flow sheet and the economics. And I think he's 100% on board with all of those things. Our Tyrrhus project, in terms of jurisdictional support, I'll come to it in a couple of minutes, but the government of Mauritania, they haven't seen a mine built in 15 years, and they're very enthusiastic to see Tyrrhus developed, and are giving us support at every level. Our resource, well, we've got 93 million pounds of uranium with a grade of roughly 250 parts per million. But our important characteristic is that we upgrade from that 250 parts per million to 2,000 parts per million by a simple separation process, which I'll go through a little bit later. We don't have any drilling or blasting. We don't have any grinding. We have free digging, and our ore body is finished once we get to about 12 meters depth. So we've got free digging and very, very easy access to the resource. We're planning to produce about 2 million pounds a year, although we've looked at expansion opportunities, and we'll talk about that a little bit later. Hagen is a polymetallic. Because of the way that the ASX imposes the constraints around mineral resources, we haven't been able to include our uranium as part of our studies. But once Sweden lifts that ban, we'll be able to include the 800 million pounds of uranium, and Hagen will become a very interesting project. Let's move forward, Jane. I talked a little bit about Mauritania. We're in Mauritania. We're in the northern eastern part of Mauritania. You can see SNIM there, which is a project that's been running for almost 50 years, producing iron ore. They've created a railway line down to the coast, and they're about 500 kilometres from where we are. The environment is one of very good support for mining projects. First Quantum have been there for 30 years with their copper mine. Kinross have been at Tasiast for 20 years. BP have just opened a multi-billion-dollar transaction with Mauritania and Senegal as a joint venture. So host community, very, very strong. Political stability. President Ghazouani just last year secured his second 5-year term. We have all the licenses that are required, ready to develop the Tyrrhus resource. We have legislation that allows us to export the uranium. Mauritania is a member state of the International Atomic Energy Agency. It has been for a very long time. Orano are helping us with logistics to allow for the seaborne transport of our uranium, and there's a lot of collaboration with the US. So let's keep going, Jane. Project economics post-tax, our NPV is at about 500 million on the current project, with a 39% IRR payback over 2.25 years. We've done some sensitivities. If we hold the resource at the same level and increase production from year 3 to 3 million pounds, we drive that NPV up to 520, 530, assuming we don't find any more resource. We have operating costs at about $35 all in, and about 31 on an operating cost basis. So we are going, whatever people have been talking about, we need to see increases in uranium price before people are going to pull the trigger on adding new greenfields capacity. We do not need that. We have capex of about 230, and we're deep in discussions with financiers that I'll come back to. And we have very substantial exploration potential that I'll come through to. Jane, let's go to the next slide. We probably don't need to go through that because I think we've been through that. But 500, yeah. Keep going, Jane. As I said, we take the material out of the ground at about 250 parts per million. We put it through a scrubber, and the fine material goes off to the process plant. The fine material is about 75 microns. It represents about 13% of the mass and 91% of the contained uranium. And 87% of the material just goes, it's larger size, and we just put it straight back in the pit. So we're only processing 13% of the mass through our flow sheet, and we're producing about 2.1 million pounds. We're mining about 7 million tons of material. As I said, we're only digging to about six meters. We're using conventional truck and shovel. We backfill directly into the pits, and so it's a very simple operation that sees us upgrade very quickly from 250 parts per million to greater than 2,000 parts per million. Let's keep going, Jay. Here's our flow sheet again, and we have four modular units. I think we will ultimately consolidate that to less than 4, and that engineering is underway at the moment. 91% of the uranium is picked up through that scrubbing operation. Then we put it through leaching, filtration, ion exchange. We precipitate out the uranium, and we put it on a boat. So it's a very simple flow sheet. You've seen it at Langer Hydric, and we're pretty excited about it. People who are scratching their heads saying, "How do you separate so easily?" The answer is we've tried it more than 500 times, and it works extremely well, the upgrading. So let's keep going, Jane. This is our resource, 91 million pounds. We did a little drilling program last year. One of our shareholders we announced the drilling program where we said we're going to do $4 million on drilling. One of our shareholders wrote to us and said, "Why would you use $4 million on drilling?" All we did was increase our resource by 55%. For $4 million bucks. We've paid about 20 cents a pound for our uranium. We've identified this group of resources here that you can see on this page, and that's where we found 91 million pounds. But Jane, if you go to the next page, we have asked the government through lease applications to increase that lease area by 28 times. So if you see the blue area on the right-hand side of the slide, the blue area is the resource area that we have defined the 91 million pounds on. You can see the radiometric targets that we've identified in the lease areas that we've put exploration targets on. And we're pretty excited about the untested potential. The other important thing to see on this slide is the area at the bottom called the Chiodini Basin. This has been a source for SNIM, the local state-owned iron ore producer who's been operating for 50 years. Uranium Basin is their source of water. You may think that being in the middle of the Sahara Desert, that water would be a problem. We had our friends from Knight Pisold do a little drilling program for water with us, and we're capable of producing about 75 litres per second. So water from the Uranium Basin is a very substantial resource. So number one, we've got a fantastic resource that we've used to base our feasibility study off at Tiris East. We've got our foot on some very substantial expansion opportunities. We've got access to a government that's very supportive of us, and we've got access to water and other resources. Jane, if you could just go to the next slide. Uranium for Tiris, we've got all of the licenses ready to go. We've got the resource, we've got the NPV, and as I said, if you use that alternative production scenario where after year 3 we drive up to £3 million, that NPV increases by another 10%. Project funding, we're in discussions at the moment with a Western sovereign development bank. We're in discussions with a number of strategics, and we're in discussions with a number of traditional financiers. I'm hoping that financing will certainly be done by the end of this year, but I'm hoping we'll get something announced in Q3 or early Q4. Early works, we've got a little plan to get our campsite underway and some infrastructure underway this year. We've got a little bit of our production off taken at the moment, and we have a potential contract with a US nuclear utility. But because we're talking to strategics as part of our funding plan, we've been pretty cautious about taking that offtake too far. We think we'll be at a decision to mine before the end of this year, and we have about an 18-month construction period. On the right, you can see some helpful photos. You can see it's a pretty flat environment. You can see it's a pretty dry and sandy environment. You can see the water drilling in the background. So very simple operation, and we're hoping to push the go button during this year. Jane, next step. Hagen, as I said, we were with the Parliament this last week. They're looking to overturn the uranium ban in January. That will allow us to really put some focus on the Hagen project. It's a very large resource that we've got our foot on. We've got a foot on 2.5 billion tonnes with 800 million pounds of uranium there. Our studies to date, which show NPVs around $1 billion, don't include any credit for uranium. They were just selling the other polymetallic products, vanadium, sulfate of potash, etc. Once we include the uranium, even at a small rate of about £1 million a year, that NPV is going to become much more interesting. Jane, do you want to go to the next slide? So you can see this is using the study that we did, which was very high level, was only accessing 3% of the resource. So if you look on the right-hand side of the slide, the mineral resource that we've identified is that area in pink. And that contains 59 million tons of polymetallic ore, from which we would produce on that high level study something like 10,000 tons of V2O5, something like 215,000 tons of sulfate of potash, and something like 1 million pounds of uranium over a mine life of 17 years. But this represents only 3% of the resource that we have available to us. Capital cost of something like 600 million, operating cash flows somewhere around 300 million, all-in sustaining costs about $3 a pound of vanadium, but we'll convert that into uranium shortly. Payback period a couple of years, and a post-tax IRR of in the 30s or 40s. So why don't we keep going, Jay? So for us, Tyrrus and Hagen are cleaner energy suppliers in an energy-hungry world. Tyrrus is near-term, great economics, great support from government, great resource, very expandable, fully licensed. We're in discussions with financiers, hope to be in production in 2027. And we have very substantial growth opportunity at Tyrrus, and Hagen is an undiscovered gem. So thank you very much for your time.
No, Phil, thank you. I think keeping you up for as long as what we did, particularly while you're in the UK, I appreciate it. And thank you so much. It was Guy's fault for keeping us on the line for so long, as always. But Phil, I'm going to jump into some questions because we did get a lot that came through before you jumped on the call. So Tyrrus project is described obviously as a near-term uranium producer. It's got outstanding economics. So again, walk us through how the project's simplicity and low-cost structure give Aura that competitive advantage, particularly in the uranium market today.
Yeah, Jane, if I can get you to go back to slide 12. Yeah, so you ask about simplicity. We are very shallow digging. You just blow the sand off the surface and then dig for 6 meters with a strip ratio of 0.8 to 1. We only mine 7 million tons of material each year. We use conventional truck and shovel. We take the material out at 250 parts per million. We drop it through a scrubber. We separate out the minus 75 micron material, which represents 13% of the total amount mined. We send 87% straight back into the hole, and we only process that 13%. So that is at the heart of why does this thing work? We only process 13%. Then we put that through a very simple, well understood technology approach. Why else? The answer is because we've got great expandability and we've got a great host government.
We've discussed this a lot on today's webinar. It's been the topic of conversation for the whole webinar, in fact, and you have discussed this as well. But with the rise of AI and data centers driving that demand for carbon-free baseload power, how do you think Aura is contributing to this global energy shift? And what conversations are you having with potential off-takers in tech or utility sectors?
Look, as I said at the outset, the energy per capita around the world is growing, and it's growing in hungry places. Are we ready to sign up with AI opportunities? Absolutely. As I said, we've been keeping our powder dry, or our yellow cake dry, because we've been focusing on how do we put the $250, $300 million of capital funding together, and we're talking to strategics who are enthusiastic about helping AI players. We're talking with traditional players, and we're talking with a Western Development Bank about how we can supply each of those people with strategic uranium.
Sounds exciting. I think let's go back to the resource at Tiris. So obviously we reported a 55% increase in mineral resource and a 49% increase in ore reserves. So how does this enhanced scale influence in the company's long-term development plans in Mauritania?
It underwrites our feasibility study. It gives us a 27-year life, 25-year life. It underwrites our economics. It keeps our expandability options available, and that was what allowed us to look at expanding to 3 million pounds. I'm sure that some of that 28 times area that we've asked the government to appropriate to us will even further expand that resource and give us greater optionality.
I guess so, yeah. And I think, look, we actually had this conversation earlier as a shareholder myself, but one you probably get quite a fair few times. But Northern Mauritania, it's obviously being positioned as a new uranium province. You've already got that tenement package, and you've applied for a significant package of new tenements. Maybe give us a bit of background on Mauritania and what's the broader vision for the region? How confident are you in its untapped exploration potential?
Oh, well, if you go to that slide again, Jane, slide number 14. So our feasibility study, our development opportunity is the blue area. That's what underpins the Tiris project. Those red dots that you can see through the green application areas are where radiometric signatures have been identified from earlier exploration work. And so why do we think there might be uranium there? Well, the radiometric signals give us pretty good indicators of that. And as we have looked through, as we've reconciled the radiometric signatures at Tiris East against where we've actually found the resources, there's been very high correlation.
And look, I think finally, FID is expected for the end of the year, and uranium production expected by 2026, 2027. Perhaps just reiterate to the attendees online, news flow catalysts they should be watching out for.
Yeah, by all means. Well, news flow for us is slide 15, and we've got all of the necessary licenses. We've got the capital cost work being re-reviewed, and opportunities for sourcing nailed down and refined, and that will happen in the next couple of months. So confirmation on capital. We've secured the water for the project. Basic engineering, as I said, the basic engineering will be completed in July. We've got some early works that are going to happen later this year, and we've got some off-take discussions and financing discussions by the end of the year. So all looks pretty helpful at this moment, Jane.
Yeah, absolutely. Phil, once again, thank you for sticking on the line as long as you have. And if we've missed any questions, please feel free to reach out via the contact details on the bottom of the ASX releases or via info@janemorganmanagement.com.au. But Phil, thank you again for your time.
Thanks, Jane. Thank you, everybody.
And thank you all for joining us for the JMM and Tribeca Nuclear Energy Virtual Event Series. It was a pleasure to host you again today. And again, if we've missed anything, reach out. But we look forward to hosting you next time.